So Fenner is an industrial manufacturing company. Two divisions. There's the engineered conveyors systems, which is really the traditional Fenner business. That's big conveyor belts, polymer conveyor belts used in coal mines, other types of mines, concrete factories, things like that. And then the other part of the business, advanced engineered products, is also polymer products. It's things like polymer hoses and polymer seals for industrial applications, for oil and gas applications, and then also down into smaller polymer systems, including medical, where they make some very high-end, sort of high-growth medical applications, surgical applications, etc. It's a business that has had cyclical pressure, especially as you can imagine, on those commodities businesses in the last 2 or 3 years. It looks like we're now entering a cyclical upturn, and you've seen now the share price started to rally to reflect that. But our view is we're just really still at the beginning of a rally that can go on for several years yet. So the main drivers, I think, in the next 2 or 3 years, it comes from the recovery in those commodity sectors. So on the conveyor belt side, you have in particular the coal industry, been under tremendous pressure in recent years. In fact, it stopped in the North American coal sector almost zero order flow in the middle of 2015. So it's a business that was really under a lot of pressure. And then on the oil and gas side, polymer hoses, one of the big applications is hydrofracking. So again, a business that had a big sort of capex decline for several years. Now what we see is a recovery is pretty well established now in that oil and gas business. The rig count in the US has been increasing for several months now. Most forecasters think it carries on increasing in 2017. And on the coal side also, the beginnings of the cyclical recovery there from a very low base. And I think the change of administration in the US probably helps there in that you have maybe a more supportive view for the coal industry. It's not all US business. They've got Australia also, they've got South Africa, also EMEA, but in particular it's the US where the great weakness was. And the important thing to note is, you know, these businesses, the coal business is now about a quarter of the conveyor belts systems division, and the oil and gas is a bit less than 20% of the engineered products. So when you think about it, okay, they're not the complete drivers of the group, but they are in the sense that there's a big drop through to the bottom line. If you incrementally start making some more sales in those businesses, we think about 70% of that drops through to profit. So 10 million of extra sales in oil and gas would be 7 million of extra operating profit. So it's going to make a big difference to the bottom line if that recovery keeps going, which appears to be the case. So I think that's the biggest earnings driver on a sort of 2-year, 3-year view. In terms of the more sort of longer term qualitative elements of the group, you know, what really makes it an attractive group, there are some structural growth as well as cyclical growth elements. And in particular, we talked about the medical. That's a business actually where the company believe they can double that every 5 years. So it's a strong secular growth type business. In medical, it's things like surgical implants, a specialist packaging for surgical, you know, holding body parts and so on. And they have some new products coming through. They're reporting very strong demand for those. And so they're really seeing a lot of growth coming through in medical. So that sort of balances out, I think, a little bit of the cyclicality in some of the more commodities businesses. But also even within the industrial and the commodities businesses, actually it's a group which it remained profitable right through the commodities downturn in 2014, 2015. And it's a business that generates value through the cycle. It's not just something that cycles up and down with the industry trend. It's something which from peak to peak, you'll see Fenner is adding value through the cycles. So I think, you know, whether you look at it in terms of return on invested capital or you look in terms of cash flows, you'll see that this is actually a quality group which generates value both in its cyclical and in its less cyclical businesses. So the investment thesis from here, you're looking at a share price which has trebled from its low points of last year. So you're looking at a cyclical recovery which, you know, appears to be somewhat reflected in the share price already. And if you look on a 2017 PE multiple, on consensus numbers, it's about 25 times PE. So you may sort of look at this and think, well, okay, this is, you know, it's had its recovery run already. If you look back at the last cycle, the peak, the trough to peak recovery was a 15 times increase in the share price. So the trick not to miss with these guys is, the cyclical recovery, it goes on and on. It's not blink and you've missed it. So, okay, we've had a good recovery in the share price, but actually we think there's still a fair way to go. And the way to look at it is this: if you look at the EBIT numbers and where they could quite conservatively get to in 3 to 4 years, I would see 100 million of EBIT is a very realistic target. On that basis, you'd be looking at £1 billion enterprise value. And in share price terms, that means we're still looking at 60% upside from where we are now. And that, I say, is being fairly conservative. So yes, the shares have had a good run. Yes, on a short-term PE, they don't look all that cheap. But actually, you could have said that in 2010 and you'd have missed a lot of upside then. So I think it's one, don't miss out again. There's still a way to go with this.